Welcome, everybody. I am really super excited to have Eva Benesoky here, who is the CEO of Canadian Passive Investing. She is educating investors to build wealth through real estate. I've spoken to her and met with her a few different times on Zoom, of course, and she's just absolutely not only gorgeous on the outside, but gorgeous on the inside as well. And I'm really excited about the entire foundation that you guys have been building, and I can't wait to learn from you. So please take over.
Thank you, Randy. I'll go ahead and share my screen with everybody here. And then just let me know if you can see this.
Yes.
Good to go? Fantastic.
Yeah.
All right, I'll put all of our faces on this side. All right, so I'm going to do two presentations tonight. On a high level, I'd like to just let everybody know who am I, who is my company, Canadian CPI Capital, originally known as Canadian Passive Investing. And then the next presentation, I just want to show you guys a preview of an opportunity that I'm looking at. So it all makes sense once I tell you my business model, then you can actually see it in the works. So I'll just bring my thing over here, just 1 second here. So CPI Capital, we have redefined real estate investing, and I'll go into that. Oh. Okay, so we're very passionate about building generational wealth for our investors. So I'm going to take a step back. When I say real estate investing redefined, what we've done here at CPI Capital is we partner with retail investors to purchase institutional multifamily assets. So essentially what we're doing by redefining real estate is we've democratized real estate investing so that retail investors, the everyday person, can have an opportunity to put their money, their capital, into an alternative investment and build wealth like the top 1%. Okay, so we're really passionate about that. We have a little bit about me and where I'm from. I have a background in real estate, like Randy. I've been a real estate agent for over a decade now, and my business partner has a construction background, and he's been in real estate for 15 years now. So together we have about 20 to 25 years of experience. Here in Canada, we've done about $100 million worth in real estate transactions here in Canada. And now the two of us came together about 2 years ago, and we started our company, Canadian Passive Investing. And essentially what we've done is we set up a system to help people build wealth. And I'll dive deep into how we do that. Now, when I speak of institutional investments and this alternative investment in the US, it all kind of sounds a little bit scary for the average person, myself included, when I first kind of heard about things. But when we dive deep into this, when I say invest like the top 1%, an institutional investment is something that is 20 million plus. Okay, so the challenge would be for an everyday person, we can't do that on our own. Okay, we have to come together as a group to pool together capital and purchase these institutional investments. So the challenge would be, number one, we can't have that money on our own. We don't know what kind of markets, we don't know where to go to kind of dive deep into these alternative investments. Another one here is a lack of familiarity with specific markets, capital commitment and liquidity, and the property management and lack of direct oversight. So let me just kind of explain what I'm talking about here. As an investor, there's two different kinds of investors. There's a passive investor and an active investor. An active investor is somebody who goes out and, of course, like a landlord, they go and find the property, they manage the property, and so forth. A passive investor, and that's who I work with, passive investor is somebody who sits back, they write a check, they sit back, and they leave it in the hands of the person who's managing the asset, which would be myself. So the benefits of being a passive investor, and I'll just move us over onto this side so that we can do this, is the benefits of being a passive investor and getting involved in the business model that I do, a real estate syndication, is it allows you to pool together your capital with other individuals and purchase institutional assets. When you purchase an institutional asset, you're going to be seeing very attractive returns that you have not seen before, of course, because you're investing like the top 1%. We have tax efficient structures put in place, and what it is you get reliable passive income. Now, I'm from Canada. I live in Vancouver, British Columbia. Everybody always asks me, Ava, I have a question for you. Why are you not syndicating properties in Canada here? And it's a very, very simple answer. The numbers in Canada do not make sense. Here in Vancouver, the cap rates are super compressed at a 1% to 2%. So on something like a multifamily, you're going to actually be in the negative cash flow for a little while. You have to have very deep pockets to get involved in something like this. Now, even when it comes to purchasing a one unit condo, I used to, here in Vancouver, I worked with a lot of investors and they always say, Ava, I want to put my money into real estate and I want to see cash flow. And I said, unfortunately, that's very hard to find here. When I used to sell real estate in Alberta, which is completely opposite from BC, people were buying with a very little cash flow. People were purchasing properties for a little bit of cash flow, but not much appreciation. And in Vancouver, obviously, there's zero cash flow and you're purchasing for appreciation. Now, when we go to the US, what's super exciting about the US is the rent to value ratio is a lot different and the cap rates are not as compressed. So that means that when we purchase properties there, we can see the beauty of what cash flow is like. Now, Canada versus the US, I'll kind of go over this on a high level. It's 1/10 of America's population. Only 20% of the land mass is inhabited and it has a high density of population in large cities. So there's not much room to expand out. The areas that we target in the US, there's so much land there that you can literally have a community, a multifamily community, where it's a 2-level story garden style, resort style community that's spread out for people to live there. And it's very, very popular in the US. And that's what we target. So market saturation, when you have market saturation, prices are high and there's negative cash flows, unfavorable mortgage and landlord laws here in Canada. Sellers markets leading to overvalued assets. So once again, classic supply and demand. And as I said, the low cap rates in Vancouver and Toronto as a 1% cap rate. Again, why the US? There is super high population growth. The proximity to Canada, right across the border. The US, where we target, there's very friendly business laws. So that's really good for us. Untapped growth markets, and there's a high GDP growth. So now I'm going to get excited and tell you guys about the markets that we target in the US. Now we target, Arizona is our first market. Arizona is our first market that we target. That's a little tongue twister. And why? Well, there's an interstate migration happening right now, okay, from California and New York. And what's happening is everybody's moving into these markets. Now, when we see high population growth, high job growth, that means that there's a lot of opportunities for us as syndicators to go after multifamily apartment communities. Another market that we love is Texas, same thing. And same thing, it has a booming economy and hot job market. It's very business landlord and landlord friendly. And it has a steady population growth with increased demand for rental properties. So the assets that we go after, multifamily, apartment, garden style communities, what we do is we purchase the asset and we rent the units out. So if there's high job growth, that means that we're going to be getting our rents in. So that's a really positive thing for us. Another market that we are very interested in is Georgia and the Carolinas. Right now, I'm going to focus on the Arizona and the Texas because we are in there. Those are our two favorite right now. Now, we kind of went over the barriers for individuals. So I've talked about that. So our solution. So here at CPI, what we've done is we got the best lawyers and the best accountants together, and we didn't reinvent the wheel. We actually seen opportunity in the US and we said, wait, for myself, I'm 31 years old, and I've never in my life been taught this alternative investments. Make your money work for you while you sleep, make your money work for you while you're doing what you love, focusing on the craft that you're best at. I've been a realtor for the last decade, and I personally love to put in 8 to 10 hour days. And if my parents would have taught me that while I'm doing what I love, okay, I could have my money working for me in the background, I would have started 10, 20, as far as 10 years ago when I got into real estate. So I'm making it my life mission, if you will, and I'm very passionate about this, is educating people on alternative investments. My company is not the only alternative investment out there. There's so many different kinds. And I say there's so many different kinds because my number one advice is to diversify your money, put a little bit here, put a little bit there, and a little bit over there, and get it working for you. At the end of the day, get it working for you. So what we've done at CPI is I said, wow, this is incredible opportunity across the border. Well, how do we do this with Canadians going into the US? There's a lot of red tape. There's a lot of pain points, such as double taxation. A lot of Canadians are super conservative. They do not want to put their money into the US. It's scary for them. So what we've done is we have created a unique corporate structure with the best lawyers and accountants. And we have the system now where we can pool money, Canadians' money. And it's quite simple, but essentially through a web of corporations and limited partnerships, we have opened the doors for fellow Canadians to have this US alternative investment with relief of double taxation, almost dollar for dollar. And I can get more into that without confusing everybody, but it's super cool. There's a tax treaty between Canada and the US, and essentially we have everything sorted out on that problem. And I got to tell a quick joke. My dad was saying to me when I was telling my parents about this opportunity, they're both accountants, okay? So they know how it works with the taxes and this and that and this. And I'm like, listen, guys, with our structure that we've created, I can relieve you guys of double taxation. And my dad goes, you need to patent this. I'm like, Dad, there's no patent here. This is something that exists. It's a treaty between Canada and the US. So that was something I always have to share with people because it's really, really quite funny. So our solution, we have our corporate structure. Check, good to go. Effectively servicing both US and Canadian investors, check. So we also service people in the US. There's different laws in the US. So right now I'll kind of focus on the Canadian side because keep in mind the terminology is different for my US investors and my Canadian investors. So if we have any US people here today, no problem, I can get out on a call with you. We're legally compliant with all the Canadian and US securities regulations. Okay, tremendous tax benefits, including bonus depreciation and avoidance of double taxation. And of course, we are an experienced team with decades of real estate experience. So here's our beautiful process. It's kind of I'll keep it simplified for you and I'll kind of go through this on the next few slides. First step that we do is we identify the key regions. And I like to go through this, and our presentation is a little more detailed than other people's presentations, but I am an educator and I really like my investors to understand, okay, wow, this is exactly what they're doing and this is how it works. So please forgive me if this is a little bit longer than usual, but I'm going to go on it and simplify. I'll go on a simplified level for you guys. So first step, we identify the key regions. Okay, so we say, okay, where is the job growth? Where is the population growth? We follow the numbers and we go after that. And keep in mind, when I say we follow the numbers, maybe 1 year Georgia's looking a little bit better than Texas over here. So we take care of that. Next step is we identify the target properties in the region. So we look for what I like to call diamonds in the rough. So we found the region, in this case, let's say Arizona, and now we found a beautiful asset that checked off all my criteria that I like to see. So for my criteria, my team's criteria, we're very strict. We literally stick in a white and black criteria. We stay within our sandbox and we go for asset criteria. Number one, we go for Class B multifamily assets, okay? Then we typically seek properties built in the 80s. We like larger assets, ones that are 100+ units. So imagine this, if you're an investor and you're investing into a fourplex and you have one person that can't pay their rent, you're going to be affected, right? You're going to be really affected by that. At 100 units, if you have 5 people that don't pay their rent, well, that's not going to hurt you as bad. So we like to support economies of scale and go for the 100+ units. Fourth, we stay away from Class A assets due to the reliance on asset appreciation to generate investor value. So we prefer assets where we can create value, force appreciation, do minor renovations. That's why we go for assets built in the 1980s, so that we can not only rely on appreciation, but we can force the appreciation as well. Number 5, our goal is to find diamonds in the rough, underperforming assets in quality neighborhoods. So we always look for a beautiful neighborhood with an asset that's a little bit underperforming, where there's some renovations that need to be done, so we can force the appreciation and essentially reap the benefits for our investors on the back end profit. And I will discuss that moving forward. Number 6, market rent and sales comparables help us determine whether an opportunity is truly worth pursuing. The next one is, the next step in our business model is preliminary due diligence. So we got to get it right, determine the neighborhood, determine the current and future demand for housing in the neighborhood, supply constraints, compare expected door costs to new builds to determine affordability. We do the property financials. So we get into the nitty gritty and we make sure that everything checks the box so that it benefits our investors at the end of the day. And 95% of reviewed opportunities are disqualified during the preliminary due diligence period. So we're really strict. We make sure all the numbers make sense. And then we say, let's take it to the next round, or nope, this is getting pushed to the garbage. Submitting an LOI. This is where you submit a letter of intent. So this is, in these markets, it's very competitive. So essentially what we have to do is when a property hits the market, everybody gets excited about it. And there's a call for offers date, and that's where you submit your LOI. You tell the seller, hey, listen, I'm interested in this. I want to be put in the running to be part of this. And that's where you submit an LOI. You're kind of telling them, okay, I'm coming in at this price. This is my team. This is who we are. And we further investigate. And right down here, it says, LOIs provide us with protected time to investigate further without worrying about losing to a competitor. So we submit an LOI to be in that competitive stream because everybody else submits the LOI who's serious about putting an offer in on the property. So next step is we complete financial analysis. So we do a deep dive into the newly acquired financial data, which ensures the property truly meets our criteria. So on the back end, there's a ton of numbers. We put it through our underwriting model. We have a very incredible underwriting model that tells us, okay, if we purchase it for this amount and the rents are coming in at this amount, so now we know what our investors are going to be receiving for cash distributions. If we buy it for this, if we do this kind of renovations, what are things looking? We look at the performance of the asset for the last 12 months. We kind of look at those fun numbers. I don't want to bore you with that. Then we do our physical due diligence. So we walk the talk. We actually go before purchasing the asset, we go boots on the ground, and the team walks every single unit of the property. So we know exactly what we're getting into. And this is what we call physical due diligence. So you'll see down here, this is our regional asset manager, Bruce Wollett, and he is 150-point checklist, ensures our experienced due diligence team reviews all the key aspects of the property and each unit. And I'll get into who Bruce is, but he's part of my team. Sorry about this. This is a slide that we're still working on. Financial model and operational plan. This is where we sit down as a team and we go, okay, what kind of renovations do we want to do on this? What are the numbers going to be? And so forth. Once we figure out, okay, wow, the numbers are incredible. Our investors are going to be seeing amazing returns. This gets us excited. Okay, now it's time to submit a purchase and sale agreement. Now it's time to make this official. And essentially what it is that finalizes the purchase price. Earnest money deposit amounts and timelines are now good to go. So we have the subject removal date, the final inspection and due diligence period, of course, and all that fun stuff that Randy knows exactly what I'm talking about, and anybody else who's done a real estate transaction before. So once we have it under contract, the next step is, okay, let's show this off to our investors. Let's show them this institutional investment that they've probably never seen before, but we're going to show them this alternative investment. And we do something called an investor offering. So what that usually is and I can I'll touch base on some of the boxes at the bottom here, but what we do is we host an exclusive webinar for our investor club describing why we've chosen this asset, what's great about this, and what kind of returns are you going to be receiving as a passive investor. And essentially what we do is we have a website where you can click on the website and you can actually subscribe. So you can make a soft commitment, and eventually when the deal goes live, then it's kind of a first come, first serve basis. But I'll get more into that I wanted to mention something down here, democratized investing. For our fellow Canadians, when I say democratized investing, we've truly democratized real estate investing. And what I mean by that is these institutional assets and these alternative investments, they're usually made for accredited investors. So an accredited investor is somebody who makes 200,000 plus. Okay, there's some other things in there, but I don't want to get this complicated. So they usually make 200,000 plus. What we've done at CPI is me with my real estate heart and seeing the struggles with people wanting to put their money in real estate but not being approved for a mortgage, or having 100 grand sitting in the bank account and not being able to put it anywhere. In real estate, what we wanted to do was open the doors for the everyday person. So through an offering memorandum exemption, and that's something that I can also discuss later, but essentially we've opened the doors for non-accredited investors and accredited investors to be able to partner with us. So we said, hey, and my parents are accountants and they don't even qualify as accredited investors. So they wouldn't have even had this opportunity to get these kind of returns. So we have opened the doors and said, hey, listen, if you're not accredited, we can still take your money and you can still be part of this opportunity. So the next step is the financing and acquisition. Okay, so CPI attempts to secure 75-25 LTV loans to optimize cash flow to investors. Everybody says to me, hey, Ava, I'm sorry, how are you getting a $20 million loan? What we do is we actually have a team of people. We bring on somebody called a key principal. And this key principal has studied our team. They know who we are. They want to work with us. And they come on board as our team. And these people are worth, they have liquidity. They're worth $20 million. So they essentially sign off on the loan. So that enables CPI. We're able to now get a $20 million loan at a 75-25 LTV. So everybody always gets confused at that part, but we actually have I have sharks behind me that are working with me on my team. So that's where we're able to get this loan approved and kind of proceed forth. And that's where everybody gets to, jump on board and literally reap the benefits of this, because I know I can't get approved for a $20 million loan. And I know I can't go, after these kind of assets with these kind of returns. So that's how we do it. Now, CPI is the general partner and the passive investors are the limited partners. Okay, so we structure our business as a limited partnership. Now, CPI is liable for the loan. The limited partners have no space in acquiring that loan. They're not liable whatsoever. So that's something really important too. Our goal is to maximize interest only periods in any loan to maximize quarterly distributions. And when I say quarterly distributions, this is cash flow that our investors are going to be receiving, and I'll get into that. And we obviously utilize trusted escrow companies to complete the funding and acquisition process. Now, my favorite part, we add and create value. So when we purchase 100 plus multifamily garden style apartment community in, let's say, Phoenix, Arizona, we go after, like I said, ones that have a value add opportunity built in the 1980s, right? So we love to add and create value. This is really, really cool, you guys. When I look for an asset, I go for ones that have the classic original, they're in their original state. Okay, I call them the original vintage, the units themselves. I also look for washer dryer value add opportunities. This is where none of the units have washer dryers. They literally have a washer dryer area that everybody shares. But when I find an asset where I can add the value, not only to renovate the units, to renovate the exterior and to renovate the units having washer and dryer, we do an increase in rents. And how that works is, you'll see here, if we were to purchase a property at $25 million, it had 250 units, okay, at a 5% cap rate, which is really, really good compared to where we're at in Vancouver. And the current NOI is $1.250,000. On a high level, let's look at this box here. We increase, if you were to add a washer and dryer to a unit, it's gonna most likely increase the rent by $25 to $50. Okay. If you're going to do renovations, that's going to be about another $110. So you add the two up, that's about let's say $75. Let's say $125 to $150. When you increase each rent by $125 and there's 250 units, you're actually increasing the property value by $7.5 million when you sell the asset in 5 years. Now that's pretty incredible. So that's where investors make a boatload of money on the back end when we sell the asset. And I forgot to mention that in our business model, we only hold the asset for 3 to 5 years. Quarterly distributions. So our team, like I said, we purchase asset, we rent out the units. While we rent off the units in the US, after you pay your property manager, your taxes, your mortgage, you're left with a ton of money still sitting in your account. And that's where I can say, hey guys, I'm going to start giving you cash flow from day one. And that's super exciting for me because I've never been able to say that to anybody when I was selling real estate. So we give quarterly distributions. So we close on an asset, and from all the rent roll coming in, we're able to then still give our investors cash flow distributed quarterly. So not monthly, not yearly, quarterly, which is amazing. Supplemental financing. This is an opportunity that we can seek supplemental financing. We don't always do it, but say on year 3, the opportunity presents itself for us to refinance the property. We give our investors their original investment back. That's just, if the opportunity presents itself. I won't dive too deep into that. And on disposition, like I said, we hold the asset, we upgrade it, and by the second year, it's fully upgraded from what we planned. And then what happens is the rent rolls have gone up, so our investors are receiving more and more cash flow. And when we sell the asset in the 3 to 5 years, let's say we've done the washer dryers, we've done the renovations on some of the units on the thing. Now the asset is worth $7.5 million more from forced appreciation. But keep in mind, in 3 to 5 years, it also appreciates on its own. So now the asset has appreciated in value, who knows how much, and that's where we make a boatload of money for our investors. So they're getting cash flow distributed quarterly every single year. And then on year 5, boom, we sell the asset, we force the appreciation. Now it's appreciated by itself, and boom, we sell it, and everybody's happy. This is my team. We have August Benitez. He's our Chief Strategist Officer. I'm the CEO of the company. We have Bruce Wollett. He's our boots on the ground, knows Arizona like the back of his hand, been in the business for 20 years, reputable guy who represents us there in Arizona. And then we have George Abaru, and he's our Texas Regional Asset Manager. He is a mover and a shaker. He's all over the internet. He's done so many deals, and these guys have built wealth for people for the last years and years. So we're really happy. I mean, we've been in touch with them for a really long time, and we have a very strong partnership now. So that's kind of our team. I told you a little bit about me. One thing I forgot to mention is I'm from a really small city. I came out to Vancouver to follow my dream of selling real estate in the big city. I think I told Randy this story. And essentially, it led me to where I am right now today. And that was finding my real passion in life. And that's to educate people on helping them build wealth passively. This is my business partner. He was in construction for 15 years, wealth of knowledge. He built single family luxury homes for the last decade. He was also a huge part of real estate. He actually syndicates projects here in Vancouver. So his jaw literally dropped when we started diving in deep to this alternative investment in the US, because keep in mind, he's been doing the same thing here in Canada and his partners were in the negative cash flows. So that's that. Bruce Wollett, 20 years of experience, family man. He's a general contractor. What we love about our regional asset managers is they have construction background. So they are literally boots on the ground. His company's name is Bakerson. They've been in the business for 20 years, and he's our Arizona guy. George Abreu, same thing. He has his own construction company and Elevate Commercial Real Estate Group. He also leads both construction and acquisition in the real estate market in Texas. And he's actually literally, as we speak, building his empire there. So he's another really reputable guy. Okay, so simplified investing. I know a lot of this sounds like a lot, and I'm sorry I dove so deep into it, but essentially my goal is to simplify this for my investors. So redefining real estate investing by democratizing institutional opportunities. And then we go here. I'm just going to set this over here. Securities offered in compliance with Canadian and US federal, state, and provincial laws. So I'll dive deep into that. We have a minimum investment for our Canadians at $10,000 USD. So you can get involved in an institutional 20 million plus asset for as little as $10 million USD. That's incredible. We all got to start somewhere, right? So I know $10,000, you start there, you let that work for itself. When it builds its own self up, you reinvest that, and you can literally just build yourself as you go. Now, available through an offering memorandum and private placement memorandum exemption. Okay, and I'll dive into what that is. And we work with an exclusive one-of-a-kind exempt market dealer. And that's somebody who's a licensed person under the government of Canada. So that's something I'll also dive into. Right here. What is an exempt market dealer? So I'm really proud when I get to say, hey, everybody, I work with an exempt market dealer. All of our investors are serviced by our exempt market dealer. And people go, okay, Ava, what's an exempt market dealer? So an exempt market dealer is a firm licensed in one or more provinces across Canada to distribute investment securities from private issuers. So exempt market dealers must be licensed in each province it wishes to sell such private securities. So when you invest with CPI Capital, you're investing into you're becoming part of a limited partnership. I'm the general partner, you're the limited partner. What do you receive? You receive something called a limited partnership shares. Okay, so that's what you receive back. So these investments, including the limited partnership units CPI issues, are often referred to as private capital investments that are not publicly traded. Now, only registered exempt market dealer firms can legally sell these types of investments. So EMDs are regulated by various standards to ensure they know their investments, know your KYP, their clients, know your clients, KYC, and registrants must maintain appropriate knowledge and proficiencies. So exempt market dealers are required to treat their clients fairly and honestly and in good faith. Benefits of having an exempt market dealer. The benefits of having an exempt market dealer are critical in providing passive investors with access to expertly vetted private investment opportunities. Really cool thing about this is I actually had to be approved to be on the shelf of my exempt market dealer. So that's really important because he's the government licensed body, and he said, okay, CPI Capital, we approve you. We're gonna showcase your opportunities on our platform. So they're responsible to the investors, not the issuers. So every one of our investors, including my mom and dad, are serviced through our exempt market dealer. So essentially, you're not investing with CPI Capital. You're actually applying to invest through our exempt market dealer, which is an extra layer of protection for you as an investor. So that's near and dear to us. They screen private investment opportunities by putting each deal and the issuer through a rigorous due diligence process. So any investment that I actually bring to the table, it doesn't just get presented to you guys. It has to go through this due diligence process and be accepted by the exempt market dealer. And of course, educate and guide the investor through the process of investing in the opportunity. Okay, Token Funder. Token Funder, we're really excited to be part of Token Funder. He is actually one of the most genius people alive. He's doing really cool things, digitizing tokens, securities, all this fun stuff. I don't want to focus on that today. I just wanted to focus on, he is a one-of-a-kind exempt market dealer. He's CPI's Capital's exclusive exempt market dealer. He's registered in major Canadian provinces. He is digital, transparent, know your client process, robust know your product and due diligence process, and simplified digital investing and funding process. So when you invest with CPI Capital, really cool, Token Funder has a portal. In the portal, all of the paperwork, everything to do with the deal, with your investment, stays in that portal. It's all paperless. So that's something that we offer to our investors as well, is this really streamlined portal, digitized investing, and it's quite incredible. So this is on just another high level. We already kind of went through this here. The funding process, don't want to confuse you guys too much, but let's do the building generational wealth for our investors one more time. We've kind of went through all this, so I'm just going to skip through this. Okay. You're like, Ava, this is great. We know how you make us money. How do you make money? Okay, so we get paid by fees and by the back end profit. Okay, so we have a 1% mortgage guarantee fee, 2% acquisition fee, 3% asset management fee, and 5% of depreciation upon sales disposition fee. Here is our waterfall. So how does that work? Okay, so we start off with the bank, the debt financing. So the bank gets paid back first. Then our limited partners are above us. Okay, our partners get paid before we see anything. We give a 6% preferred return to our investor.
Can I ask a question?
Of course.
Token Funder, that's a wallet, right? That's a crypto wallet.
That is a digitized wallet? Sorry.
Yes, that's what I'm asking. It's a crypto wallet, right? It's a digital wallet.
Yes.
Okay, so is the money that we are investing going to be going into that crypto wallet in crypto? So we have to transfer?
Not in crypto, no.
Okay.
No. And I can even, and please write down all your questions. You know what, the digitized, when we start talking about that, it gets a little bit confusing, but it's really exciting because it's the future. It's literally the future, and just being a private equity company who has this option, it's not offered. And the cool thing about what we're doing is, and I didn't want to really talk about this, but it's really quite interesting, is we're making it so that as a limited partnership, you have your limited partnership shares, right? Well, I just told you the term of the project is going to be 3 to 5 years. What we're doing, usually you're stuck in that project for the term. And what we're doing, and this is really cool, is we're making it possible for people to actually sell their limited partnership shares on a secondary market. So that's cool. So you're like, okay, hey, something happened in my life. I got to get out of this. I need my $100,000 back. We're making it possible for that to happen now. And keep in mind, people aren't going to want to get out of the project. They're going to want to get the back end split. But if something does happen, you're not tied up for good.
This is, yeah, it's great. Yeah.
Yeah, we're really excited about it because we're like, okay, this is another way we're democratizing real estate investing. So I'll just jump back into the waterfall. And now keep in mind, we are a syndicate. We're not a fund. So when I start talking about the waterfall and the limited partner gets this and the general partners get this, and we're actually deal specific. So a fund raises capital from people nonstop, and then they decide what they want to deploy it into. We find an asset, we present it to our investors, and then we have to raise capital per deal. And per deal, we have to do offering memorandum, everything we literally do over and over again. We don't use the same thing for each deal. So for an example, I say a 70-30 split, limited partner, the investors get 70% and general partners get 30%. Now keep in mind, this is deal specific and we're super competitive with this. You know, there's another company here in Vancouver who also offers this. And when I said we didn't reinvent the wheel, what we did was we looked across Canada and we said, okay, what companies are pulling together capital and deploying it into the US, into these incredible alternative investments. And we found one other company here in Vancouver. And keep in mind, I was a real estate agent in Vancouver. There's 22,000 realtors I was competing with. Now I only have one other company I'm competing with, so it's quite interesting. And I'm happy to say that, but we want to be competitive. So we're like, okay, what are their fees at? We're doing the exact same business model. Let's make it a little bit better because they've been doing it for 6 years and we're the new kids in town. So let's make it a little bit better. They're doing a 65-45. Okay, let's do a 70-30. In some cases, let's do an 80-20. You know, let's give our investors more. So there's enough money to go around. Trust me, these are just incredible opportunities where the money's coming in. So 70-30 investor distribution, we give a 6% pref. A lot of the other companies, a lot of them don't do a 6% pref. Okay, so they split the cash flow 70-30. A 6% pref means you make 6% before I take my 30. So anything above 6%, say it's an 8% cash on cash every year, I only take 30% of the 2%. So that's another really cool thing that we do. I'll go to the next page. And leadership, CPI Academy, we are super passionate about educating. So we have a YouTube channel where we literally bring on experts to speak about what it is that we're doing. I'll tell you one thing, Canadians, being conservative, they don't have a clue what I'm talking about at first when I say apartment syndication in the US is an alternative investment. So what did I do? Before I even looked at any assets, I said, okay, I got to educate people. They got to know, like, and trust me. They got to understand what it is that I'm doing. Once they understand, then they'll be like, oh my God, this is incredible. I want to be part of this. But it first started out with educating. So we are on Clubhouse, we're on YouTube. We host meetups all across Canada now. So we're in Montreal, Toronto, Edmonton, Vancouver. And I'm personally creating a Udemy course, which I'll be releasing in the next month, where I literally go from start to finish. There's about 23,000 words, I think, but I explain from start to finish what it means to be a passive investor in real estate investing. So that's something that I'm going to be releasing soon, and that'll make you that just kind of explains it. So that's my one presentation there. Thank you guys so much for being patient with me and listening. And Randy, I'll be very quick here. I know we programmed an hour for this, but this is what I'm excited about, you guys. And I wanted to just on a high level show you a preview of a deal that we've submitted an LOI on, and we've actually made it past the first round. So that's pretty huge for us. So like I said, super competitive market. This asset is beyond competitive. I mean, there's probably over 30 offers that went on this, and the sellers came back to us, said, hey, we like your team, we like your offer, we like your key principles, you're approved for the loan. Okay, bring in your best and final now. So we just did that today and we're really excited about it. So we'll see what happens. This is not a guaranteed, but what I wanted to do was, and before I had this under contract, what I wanted to do is I actually wanted to present to my investors on a high level of what this looks like. Okay, what do the opportunities look like? How does it work? So that if this one we don't get, that's okay. We're going to be getting 4 more this year. So it just kind of sets investors up to be familiarized on what exactly it is that we're up to. Okay, so welcome to the Valletta Apartments in Mesa, Arizona. It's an value add opportunity. These are pictures of the actual asset. And like I said, we've democratized real estate investing for retail investors to be part of something like this institutional investment. And now the door is open for ordinary people. It's an institutional quality investment, meaning that it's 100+ doors. In this case, it's 352 doors. But this is my diamond in the rough. Our acquisition team at CPI was on the constant pursuit to find something like this. I had tons of deals coming through my desk. This one hit every checkbox. And this is located in Arizona. So here's the investment overview. So I'm going to move this over here so that everybody can see the numbers. This is an institutional quality investment. Whoops, sorry. I just wanted to make sure I just have my notes right here. Okay, so let's have a chat about the investment summary. This is what I like to call the meat and the bones of the deal. Now, Valletta Apartments is a 352 unit garden style community. This was a little bit more bigger than what we wanted, but it was such a beautiful asset that we couldn't say no to it. Located in Mesa, Arizona, built in 1983, as I discussed, we like in the 1980s. There are almost 500,000 professionals and 1,100 businesses located in a matter of a few miles from where this asset is located. It's located right by the highway US 60, easy in and out for people. And our stringent criteria, I like to call my sandbox that I like to stay in, as I was discussing earlier, this asset checked off every single box. So there's job growth, check. Population growth, check. Built in the 1980s, check. Now, the really cool part, 47% of the units in this asset are in their original vintage, not renovated. So I can go in there and renovate. So that's a massive check. 47%, not 47, 47%. Now the offering summary, let's go over some of the main items here. We have the purchase price of this one is 66 million. Okay, the total equity required. So I have to, the equity that we have to pool together as investors is going to be 27 million. Those are really big numbers, but keep in mind, the minimum investment is 10,000. So you'll see the whole time here is 5 years. So our team is opportunistic. Okay, so when we say there's a 3 to 5 year hold, the numbers that we've placed on this one is for 5 years. And what that means is if the market does really well, and it looks like it's a great time to sell, we're going to sell year 4. Okay, whatever makes the best sense. Investor pref return, 6%. The investor annual cash on cash. This is how much are you going to receive yearly? If you were to do $100,000 investment, you're going to receive $7,300 distributed quarterly back in your own pocket. And the investor equity multiply. This is a very important number for investors to focus on. In 5 years' time, you will 1.7 times your money. So if you invested 100,000, you're going to walk away with 170,000. And these numbers are conservative. You know, this is just a forecast. These are just forecasted numbers. They're very conservative, and we're very conservative when we do our numbers. So that's that. Now, this is the asset. Look how beautiful it is. The first time our regional asset manager went to a property and actually said that it looks better in person than it does in the photos, which is really cool. Because Randy, you know, as a realtor, they always make the pictures look better than they really are. And he was like, wow, this is beautiful. So it literally looks like a resort, as you can see. The previous sellers already did the external upgrades. So that's why it's so beautiful. It's a gem. It's in a gated community. It has 3 resort-style pools, cozy fire pits. It has barbecues, fully equipped fitness center, soccer-filled community, and a community dog park and playground. So it literally has, you name it. This kind of goes over what it has. So it's a resort. You're in home right at a resort. Location overview. So this is Mesa. We follow the numbers. So the numbers, you'll see right here, Banner Health is right next door at 8,500 jobs. And when I said when there are people, there are jobs. And when there's jobs, the rent gets paid, which means we don't have to worry about that vacancy. So, oh yeah, there's big, and I wanted to touch base. City of Mesa, 4,000 jobs. Boeing, 4,700 jobs. Mesa Public Schools, 8,000 jobs. I mean, I'm getting goosebumps while I'm talking about this because all of this is what excites us. It's the 3rd largest city in Arizona, and the current annual population growth is 2%. But in the past decade, it was 22.5, which is great to see. So here's our beautiful asset right here. Right close by, we have Banner Health. COVID, right? There's a medical center right there. That means that those jobs are still strong. Perfect. We have the Mesa Community College right here. And we have the Fiesta District right here. Tons of entertainment. Our business plan. This property has incredible growth for forced appreciation. None of the units have washer and dryers. That's huge, right? I showed you the millions of dollars that it'll up the property. That's huge. 352 units, no washer and dryer. That's literally massive money right there. Another one, 47% of the units are in classic condition. we can go in there, and our game plan is to renovate 160 of the units. And I'll show you on the next slide, to the platinum. So here's what they look like on top. We want to make them look like that on the bottom. Okay, so that's something that is like golden dollar signs in our eyes. And not only that, let me explain something that's near and dear to my heart. We get to literally go in there and make a better community for people to live. This is somebody's home. We go in there and we give them the opportunity for a rent premium of, let's say, $130 a month. Hey, do you want to move into an upgraded unit? And a lot of the times they say yes. And they get to move right next door into a new unit. And then when they move out of their unit on the top, that's when we go in and start renovating that unit. So we give the tenants the first opportunity before we let anybody else come in. So we get to know our tenants, we love our tenants, we're a big family, and we make it a better place for them to live. And they get to have first choice. Project timeline. So when we put this under, if we're awarded this deal, and keep in mind, if we're not awarded this deal, we'll have plenty more to show you guys. This is just one that we're working on. April 2021 is where we get the acquisition in hand. December 2021 is where the lender requires us to do some renovations. And then by December 2022, we've done all the renovations. So we've put the washer and dryer in all the units that we wanted to. We've upgraded the units. And what that means is now we've bumped the rents. And when the rents are bumped, that means more cash flow. We seek supplemental financing, return capital to investors if the opportunity presents itself, and we sell the asset and we disposition the asset in 2025, 2026. On this deal, $66 million deal, we've decided to make it very beneficial to the investors. We're giving the investors 80%, and we're taking 20% of this as the general partners. Something really important to note, this cash flow from day one, this quarterly distribution of cash flow, we actually structure it as something called return of capital. So our investors are not getting taxed on this cash flow that's coming back into their pocket. Okay, so that's really incredible and really important, because people are like, wait a second, how do we do this? So we actually call it return of capital, and we don't take it off your initial investment. So if you put in $100,000 and we're giving you $8,000 back, $7 back per year, we still keep your initial investment as $100,000. So in the back end, you're still making, or you continue to make the 6% pref off of the 100,000, or the cash flow off of the 100,000. Sorry if I kind of stumbled there with my words. Okay, this is on a high level, year one. I'm just gonna point out these numbers here. This is the cash flow percentage of the equity. So for an example, this page is a little bit confusing. This is on a high level. I would prefer to go to the sample return for the investors. This kind of makes it a little bit easier. We did our investment on $1 million, but let's say 100,000 instead, so that we can just take a number off. But in this case, say you invested $1 million, year one, you'd receive 5.8% cash flow. This is before we do any renovations. Okay. Now you're like, wait a second, Ava, you said 6% I'm going to receive pref. Well, what happens is it's cumulative. So if we only hit 5.8% the first year, we're going to make up for it the second year. That's before we take anything. So on a $100,000 investment or $1 million investment, in the first year, you're going to be receiving return of capital of $58,000 back in your pocket, distributed quarterly. Now, the next year, of course, we've bumped the rents up a little bit. It's now 6.7% cash on cash that you receive. So on a $1 million investment, you're going to receive $67,000 return of capital, tax-free in this case of return of capital. Year three, it goes up even more because now we're doing other things. So 7.6, year four is 8, and year 5 is 8.6. So it kind of keeps growing. And then at the end of year 5, we give you your original investment back of $1 million. You make $86,000 return of capital. And on year 5, you make 1.4 million, or in a case of 100,000, it'll be, I can't do the math, but you get the numbers. So right over here, like we said, we want to 1.7 your equity multiply and an average cash on cash of 7.3. Okay, legal, everything I said tonight, you guys, this is forecasted. All real estate investments are risky investments. Everybody knows that. It's very, 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 very important to go through the legal documents that are provided, go to your lawyer, go to your accountant, get outside advice. Everything is forecasted, and this is very important that everybody knows that. My team, I've already gone over my team, and that is that. Thank you so much for your time.
Thank you so much, Ava.
You're welcome. I hope I didn't, I talked for about a good hour. I'm so sorry, you guys. There's so much to go over. I was so excited.
No, that was awesome. Does anyone have any questions? And again, I see not everybody was able to get back in, so I will definitely be sending out the recording. But please ask Ava any questions that you guys might have.
Eva, I'm Pauline. I just want to know, so basically, one deal is for one OM, is that right? Or one?
Correct.
So it's not, because what some company do is that they will have multiple apartment, multifamily units, and then for one OM or what?
So yeah, my company does it a little bit different. We actually create an offering memorandum for each specific deal.
Okay.
Yeah. And what happens is you can invest into multiple assets, but they're all completely different limited partnerships, offering memorandums, subscription agreements. Each one has its own entity.
Okay. You keep mentioning, if anybody want to ask question, please do so, because I will ask many questions, I think. Okay. Earlier you mentioned about Class A and Class B asset. The only thing I caught is that Class B asset is that any building that is in 1980s. Actually, what's the difference?
Of course. So Class A asset is going to be a newer asset. Not, it's not going to need much, it's not going to have value add. It's going to be possibly a new build. A Class B asset is an asset that is you're going to have that value add opportunity.
Okay. The other thing is that how many deal or OM that have you done? Because I think you started 2 years ago.
You know what? That's a very good question. So this is exactly what we've been doing. When I say I started 2 years ago, I just found out about syndication myself. Okay. So I've been selling real estate here in Canada, but I've never actually done a deal in the United States. So I said to myself, okay, wow, I can get the best lawyers and accountants and create a beautiful structure for Canadians to be able to passively invest in the US. But the most important thing that I didn't have was track record. I don't have any track record in the US. So how am I going to get investors to rely on me and trust in me when I've never done this before? That's where I brought on my regional asset managers, and I'm piggybacking off of their track record. So they're actually, we're launching our new website soon, and we have our website now, but their track record is going to be on our website. So it's very important that people know that our regional asset manager has done this exact thing over and over and over again. But Ava, myself, this is my first time.
So for example, like the deal that you have shown us earlier in that Arizona, so the investor will be all Canadian or will be some US investor too?
Very good question. So yeah, we create a limited partnership here in Canada, and all of our Canadians invest into this limited partnership. And then we open up an LLC in the US. So anybody who lives in the US invests directly into the LLC. And the Canadian limited partnership, we actually go as one entity. All the investors go as one entity into the US as one. So we're actually open to both sides of the border. The rules are different. So when we're speaking legality, we have different rules. For an example, in the US, we do not accept non-accredited investors. We only accept accredited. Here in Canada, because we can use the offering memorandum exemption, we can accept non-accredited.
About exit strategy, earlier you told us that we can exit anytime. for any reason, maybe we need the money or whatever, but in the secondary market, but how can we find the investor for it?
How can we find an investor for it?
Yeah, for example, like I own one of the your project, and then say 2 years later, I say, oh, I need the money for something else, and then how can I find the somebody to take my share, basically?
Yeah, definitely. So there'd have to be a secondary buyer, or you can even sell the shares back to the GP.
So GP? Oh, okay.
Oh, sorry, general partner, which would be, you're the limited partner, I'm the general partner. Or there'd have to be a secondary buyer that's waiting on the wait list to get into this kind of opportunity.
Okay, okay. I'd like to understand more on the slide that you have about, okay, the last one was 80-20, is that right?
Yes.
Okay, so that's mean once the project has been disposed, like you sold it, so the limited partner will get 80%, and then the GP will be 30%.
Yeah, so what we do is we take our disposition fee. So we take 5% on the profits made. And then after that, we split 80% goes to the investor, 20% goes to the GP.
Okay.
So we make our money on fees and then the profit at the back end.
Okay, then how does the US investor fall? Will be in the limited partner, I guess?
Oh, of course. Yeah, exactly. They'd be a limited partner as well.
Okay, so is this project will be your first one?
Yes, yes, yes. This will actually be our first one. And keep in mind, really exciting. And I forgot to mention, you guys, this is being sold by Blackstone. The seller of this asset is Blackstone, which is the largest private equity company in the world. So what happened was we submitted an LOI, right? They've checked, they've seen that, okay, we had to get $45 million financing, okay, for the property. We've got approved for that. So we got our financing in place. We got our team ready to go. We've submitted our LOI and they said, hey, we liked your offer, come back for second rounds. So now what we've done is we've submitted our offer today, our second offer, and Blackstone is taking a look at that. Now, it's really important that people know that these are very competitive properties, and this will be CPI's first asset that they're putting an offer on. And the cool thing is that if we don't get accepted for some, if we don't get accepted on this particular asset and we don't go into contract with them, we're going to have other opportunities. And like I said, I like to stay within the same criteria. So when I present the next deal, my investors are going to know, okay, Ava's doing the same business model. So each deal that I bring to the table is going to look the same. So moving forward, our goal, this is our first one, and our goal is to do four deals every year.
I have a question, if I may. I have a few. So what happens if you put the letter of intent and you can't follow through because there's not enough investors, there's not enough limited partners to come up with the money? What happens then to the people who already put the money in?
Very good question. So you actually don't place your money. You don't do a hard commitment unless the deal is under contract. So we wouldn't actually go forward with the purchase and sale agreement if we didn't have the money pulled together. So essentially what people can do today is they can go on Token Funder, and Randy and I will put the link in the chat box. This is the really important part. Go on to Token Funder, set up your online portal. You will be first notified when the deal goes live. So the minute the deal goes live, right now, Token Funder is for investors to go on, see the opportunity that we have and say, okay, I want to make a soft commitment. I'm going to put, let's say, $50,000. You put $50,000 soft commitment, no money's exchanged, no actual commitments there. Then when the deal goes live, that's when my Exempt Market dealer actually reaches out to you and you communicate with him, and that's where you put your hard money. So your money essentially goes nowhere. You put a soft commitment online, and then when it goes, we wouldn't actually put it in the purchase and sale agreement because in this case, there's $1 million non-refundable deposit. So if we don't have 27 million, we're not going to jump into anything because it's very risky, right? So we want to make sure.
Yes, that's right. And what is the benefit of opening a limited partnership here in Canada as opposed to an LLC in the States for the Canadians?
Very, very good question. So if you just open up a company in the States, what's going to happen is when you receive income from that asset, the States is going to take their tax. And then when you bring the money back to Canada, you're going to get double taxed here. So that's why people do not, that's why, that's why this business model, that's why there's only one other competitor here in Vancouver. It's a very intricate thing. And you have to do it right. But that's why people don't just go as a Canadian, open up a company and invest into these syndications. It's there's a lot of red tape. It's possible, but it doesn't make sense for one investor because the costs are too high. It costs a lot of money for one person to do something like that.
Yeah. And my last question is, who is funding the renovations?
Okay, so the renovations is part of the $27 million that exactly. And we build the CapEx into our model. Very great questions. Thank you.
Anyone else have a question for Eva? Well, that was, sorry, I know a couple of people came on late and we'll definitely be sharing the replay. So thank you so much, Eva, for this amazing presentation. I will share the links by email tomorrow, as well as the replay, and let others have the opportunity to hear what you had to say. And again, I apologize for my power outage and my clicking end meeting. So, and thank you to you guys who came back on after that glitch. And yes, thank you. That was a wonderful presentation. It's an incredible amount of work that you had to do in order to put this project together. I can just imagine how much back-end work was involved with securities and legal and all that stuff. So it's just unreal, so my hat off to you. Congratulations. There's not a lot of companies out there that do this. And so I'm looking forward to seeing how it goes with you guys, and good luck on acquiring the property.
Thank you.
And if you guys have questions, like even afterwards, you remember, oh my God, I forgot. I'm happy to make a connection and get you guys connected so that you can ask the rest of your questions or get them answered. So Thank you so much again.
Of course. And I just wanted to let everybody know, if you want to learn more, just go to Canadian Passive Investing Academy on YouTube, subscribe, and you can stay up to date on all the guests that we bring on our show. We bring on lawyers, accountants, all the professionals who actually explain to our investors about how everything's working. And it comes from there. Today we had an incredible lawyer on. He was our US securities lawyer. And we had a tax accountant on, corporate cross-border tax lawyer. So he explained, how double taxation, how do they do it? So we don't come, it just doesn't just come from our mouth. It comes from the people we actually work with hand in hand, the professionals that do this every day. So please subscribe to our YouTube show, and I'll be in touch. And it was such a pleasure being here. Thank you for your time.
Thank you, Ava. It was beautiful.
Thank you.
Or Ava. You say Ava or Ava?
Ava.
Ava. Nice meeting you.
Nice to meet you too. Thank you.
Yeah.
I love all the questions. Thank you guys so much. Thanks, Randy.
Thank you. Okay. Bye, guys.
Bye-bye.
Bye-bye.